is the Cryptoverse DAO education section. And as we basically look into education, do look into our Linktree page. Do follow us on Twitter, where we post everything that we do, from technicals to education to the news or any AMAs we're doing. We post them here. And yeah, do follow us on YouTube. Do subscribe and click the bell notification, because we do upload all our content in 4 categories: news, AMA, education, technicals. And today we will be covering what is Forex trading. I think this is very important, as Forex is the traditional markets that we trade, and we do leverage trading, and then there's many of these sort of acronyms in keywords that I think needs defining, and it helps you understand and build your strategy. So let's start reading into this a little bit, and then we'll give examples as we go. So what is Forex trading? So foreign exchange, right? FX or Forex market is a global market place where traders exchange national currencies. So it's where two pairs get met. So you have currency pairs within things like the US dollar, euro, the yen, the pound sterling, the Australian dollar, Canadian dollar. And then you have, so these are the major currencies that sort of pair up with one another, and then you exchange, right? So that's the start point of what the foreign exchange market is all about. Let's continue. Trading terminology. So these are things that you're going to see as you start to leverage trade, and then you basically subscribe to things like Plus 500 Trading, Trading 212, and MetaTrader, and all these brokers and stuff. These are the kind of things that you have to keep your eyes on. So I think it's important to understand and define these things. So what is spot Forex, right? So this form of Forex trading involves buying and selling the real currencies. For example, you can buy a certain amount of pound sterling and exchange it for euros. And then once the value of pound increases, you can exchange your euros for pounds again, receiving more money compared to what you originally spent on the purchase. So this is when you go to a foreign exchange executor and basically tell them, I'm going on holiday, I'm looking to convert my pounds into euros to travel to Europe. Or I'm moving them into liras or something. So spot Forex is what brings all these things into it. So this is like real money. This is real trading, and this is when you get real currency for real currency. Now CFDs is another thing that you're gonna hear a lot in the trading circle. So what are CFDs? The term CFD stands for contracts for difference. CFD. It is a contract used to represent the movement in the price of financial instruments in Forex terms. This means that instead of buying and selling large amounts of currency, you can take advantage of price movements without having to own assets itself. Along with Forex, CFDs are also available in stocks, indices, bonds, commodities, and cryptocurrencies. In all cases, they allow you to trade in the price movement of these instruments without having to buy them. Right, so if you're interested in knowing how CFDs work in greater detail, we recommend following the article that explains CFDs for beginners. So CFD is something that you'll find on all these sort of platforms, like Trading 212, like Plus 500, and you can take a single position and then trade this thing on its sort of difference of price movement. It's very different to something like spot Forex, right? So let's continue. Pips. What are pips? Pips are really important for us to understand, right? Because the second we understand the pip count on Forex pairs, on gold, on Bitcoin, or any sort of asset, the more we are able to leverage these gains. So let's define this. So a pip is the base unit in the price of the of the currency pair as 0.0001 of the quoted price in non-JPY currency. So when the bid price for Euro USD pairs goes from 1.16667 to 1.6677, that represents a difference of 1 pip. right? So 1 pip. For these kind of things, like if you are looking to calculate pips on a certain forex pair, I would say use something like a pip value calculator where you can put in things like GBP USD and you can calculate how many pips is 10 pips. So let me just refresh this view. Calculate, right? So something like this will give you a narrative of how to calculate um, how much the dollar value is in pips, right? And that's how you are able to make like pick up a trade and pick up these gains because you know how many pips were going up or down on the asset class. Something like GBP USD or Euro USD. But I hope that kind of gives you a thing about pips and why it's important. Now, spread is another thing that you will see as you take a position on a forex pair or any sort of asset. You'll know that there's a buying and selling button, right? And in between that is a spread that you buy, right? So spread meaning is there 20 pip spread, a 10 pip spread, 5 pip spread. In busier markets, when the markets are really busy at things like New York and London and Asia Open, that's when you see the spread is quite a bit. So let's read a little bit. Let's define this. The spread is the difference between purchase power and the sale price of a currency pair. For the most popular currency pairs, the spread is often low, sometimes even less than a pip. For pairs that don't trade as often, right? The spread tends to be much higher. So things like, let's say, like USD, MX, Mexican peso, something like that. That's rarely traded. We call them exotics. And when you take a position on a buy or sell on the USD Mexican peso spread, you'll find that it takes 100 or like 50 to 100 pips uh, before you're in profit because you've taken such a spread. So for pairs that don't trade, before a forex pair trade becomes profitable, the value of currency pairs must exceed the spread, right? So if you're taking a position in between 1.149 and 1.1499, you need to buy and then sell at 1.15. So it needs to be above the spread or below the spread at 1.13 or 1.12 for you to make a profit on that on the arbitrage on that move. What's margin, right? So margin is the money that is retained in trading accounts when opening a trade. However, because the average retail forex trader lacks the necessary margin to trade at a volume high enough to make a good profit, many forex brokers offer clients access to leverage. So leverage is basically so margins are how much you're risking of your account, and it's important to understand margin. So you must have heard the figure of margin call, right? A lot, and margin call means when your account's about to get liquidated. So margin is important. It's risk. So that's margin. What is leverage? So this concept is a must for beginner forex traders. The leverage is a capital provided by a forex broker to increase the volume of trade its customers can make. So this is really important. I need to read this out so we can understand this. Then I'll give an example of leverage. The face value of a contract or lot equals to 100,000 units of the base currency. In the case of Euro USD, it would be 100,000 euros. If you use 1 to 110 leverage rate and have 1,000 euros in your trading account, you can trade a currency with a $10,000 position. So it basically gives you, so by keeping by leveraging 10 to 1 or 1 of a leverage rate, you're basically, with 1,000 euros, you're accessing 10,000 euros. That's what it basically means. It means that you are leveraging higher, sort of thing. So usually when we sort of trade forex and stuff, we try to have the leverage as high as things. So we would go for 1 to 500. So now that one sort of $1,000 will give you 500,000 dollars of a position. So it's important to like leverage the as lower the leverage, the more your stop loss are going to be hit. So that's the representation of leverage. This is really important, guys, to like understand. If the trade is successful, leverage will maximize your profit by a factor of 10. However, keep in mind that leverage also multiplies your losses to the same degree. Therefore, leverage should be used with caution, regardless of whether we are talking about trading for beginners or experts. If your account balance falls below €0, you can request a negative balance policy offered by your broker. The SMA regulated brokers offer this protection. Using this protection will mean that your balance cannot move below €0, so you'll not be indebted to the broker. Now we gotta understand what a bull market and bear market is, right? So bulls and bears. Bear is the term used to describe the stock market when it is moving in a downward trend. In other words, when the prices of a stock are falling. If a stock price falls deep and fast, it's considered as bearish. So something like bearish market chart. If we can give you an example here. When things are moving lower in price action, right? If things are moving lower in price action, that means it's a bearish climate. When things are moving above, what do we call that? Bullish market. The opposite of a bear market is a bullish market. Bull market. When the stock market is experiencing a period of rising stock price, we call it a bear market. An individual stock as well as a sector can also be called bullish or bearish. Beta. A metric indicating the relationship between a stock price relative to the whole market movement. If a stock has a beta measuring 1.5, this means that when the market moves 1 point, the stock market moves 1.5 points, and vice versa. So beta is another important analogy. What's a broker? What's IC markets? What's all these sort of what's Hugo's ways? What are these brokers, right, that we use to trade these financial markets? A broker is a person or a company that helps facilitate your buying and selling of an instrument through their platform. In the case of an online broker, they usually charge a commission. So something like IC markets is something that we use a lot, right, in our groups. But IC markets is a broker, and the broker allows you to trade, and for every time you profit, they charge a commission rate. But that's what a broker is. A broker is something that allows you to arbitrage on these moves, and helps you take these positions. So that is what a broker is. Bid. This is important. The bid is the price traders are willing to pay per share. It is set against the ask price, which is the price sellers are willing to sell their shares for. What do we call the difference between the bid and ask price? The spread. So bid and ask is basically, in other words, buy and sells, right? So bid is the price that you want to buy from, and then and basically sell is sort of the price that you want to sell from. So bid and ask is sort of the selling price. So that's what a bid and ask price is. So what's an exchange now? Exchange. This is the place where trades are made. Two well-known stock exchanges are the NASDAQ and the New York Stock Exchange, NYSE. Close. This is at which an exchange closes and trading stops. Regularly trading hours on NASDAQ is 9 a.m. to 4:30 p.m. Eastern, and after hours continues until 8 p.m. So markets do close on the weekends, and it's important for us to understand when the markets close. If you're trading your Forex pairs or assets or commodities, you should know when they close. And usually on weekends the markets are completely closed. So day trading. What is day trading? This when traders buy and sell within a day. So when a trader takes a position within the day on a Forex pair and then closes on the same day, that person is known as a day trader. So day trading is a common trading strategy. However, if someone day trades, they may also make long-term investments as well, long-term portfolio. The following terms apply only to share trading. So these are things like more about blue chip stocks, you know. So what's a dividend, right? So when you hold a stock, what is a dividend? A portion of the earning of a company that is paid out to its shareholders, the people who own their stocks. These dividends are paid out either quarterly, 4 times per year, or annually, once per year. Not every company pays its shareholders dividend. For example, companies that offer penny stocks likely don't pay dividend. What is blue chip stocks? These are stocks in big industry leading firms. Many traders are attracted to blue chip stocks because of their reputation for paying stable dividend payments and demonstrating long term and sound fiscal management. Some believe that the expression of blue chip derived from the blue chips used in casinos, which are the highest denominations of chips. So blue chip companies. So now what I'm going to do is, now that we've been through this sort of abbreviations, it's important to understand a good strategy to trade, right? So here's 10 Forex trading tips for beginners. Know your markets. One of the most effective ways to avoid losses in trading is education of the Forex markets. Taking the time to educate yourself on the currency pairs and what moves their prices before you risk your funds may save you from making simple mistakes that could cost you more than you can afford to lose. This is a time investment that may save you from stress and losing a lot of funds. Sticking to your plan. Setting up a trading plan is an important component avoiding losses. Many traders include the profit goals, risk tolerance levels, evaluation criteria, and methodology. Once you have created a plan, be sure each trade you make does not fall outside the parameters of your plan. Remember that you are likely to likely the most rational before you enter a trade, and least rational after you place it. So when you take a position on the markets, it's really important to have a strategy, to have a stop loss, to have a take profit zone, and once you've taken your position, to not panic and move away and diverge from your initial plan. So I think that's what they mean by stick to your plan. Practice. Practice is very important. Put your plan into practice with a free demo account. So download MetaTrader 4 or 5 on your phone. You'll see what it's like trading currency pairs with your trading plan without risking your capital. Forecast the market conditions. This is really important. Whenever you're trading the markets, it's important to look at the charts, right? To look at the charts and see what the market conditions are. Are we in a bearish market climb? So if we're looking at Euro USD, is it a bearish move going downwards? Are we looking at an upward move? These are important things to look into, to examine what the market conditions are. So some traders choose to predict the market based on what. Let's plan this. So you'll see what it's like trading currency pairs. Cool. Some traders choose to predict the market based on what's happening in the news or other political or financial data. These are called fundamental traders. So people that look into economic data, things like Forex Factory, and look into like all these calendars. These are the folks that basically are called fundamental traders. They look into things like FOMC and interest rates. Others choose to predict the market movement based on technical analysis. Tools such as moving averages, Fibonacci retracements, and other indicators. These are called technical traders. Many traders use both. Regardless of your trading style, it is important to not forget about the tools available to you via your platform to help you predict the markets more accurately. Now this is important. Know your limits. This is a simple yet key rule. These include knowing when to exit a losing trade instead of continue to wait, setting stop losses levels accurately, use a leverage ratio according to your needs, and remember to never risk more than you can afford. Know when to stop. When you have time to sit and watch the markets every minute of every day, you can better manage your risk and protect potential profits through stop and limit orders, getting you out of the markets at the price you set. Trailing stops are especially helpful. They trail your positions at a specific distance as the markets move, helping to protect profits should the markets reverse. Placing contingent orders may not necessarily limit your risk for losses. So it's important to put a stop order when you take these positions. It's important to have a plan, to have a spreadsheet, something like this, something that you can put your initial balance in. You basically put the amount of percentage you like to risk of your account, and then and then it tells you the targets that you have, you know, and then if you get wicked out, then you're able to go back and, you know, put in the new sort of balance in, and be able to see how so this is important to have a strategy of this kind, to know when to stop. Leaving your emotions outside the door. This is really important. You have an open option, open position, and the market's not going your way. Maybe you could make it up with a trade or two that don't fit with your trading plan. Just a couple couldn't hurt, right? Revenge trading, we call this. Rarely ends well. So never go against the market conditions. If you've been stopped out, don't revenge trade. Don't go against your emotions, right? So don't let emotions get in the way of your plan for successful trading. When you have a long losing trade, don't go all in. Try to make it back in one shot. It's smarter to stick with your plan and make the loss back at a little time, back a little at a time, than to suddenly find yourself with two crippling losses. So yeah, adjust your emotions, guys. Stay slow and steady. One key to trading: consistency. All traders have lost money. Realize, guys, you are gonna lose money. I've never known a trader that has had 100% gains. They've always had a loss. But if you maintain a positive edge, you have a better chance of coming out on top. Educating yourself and creating a trading plan is good, but the real test is sticking to that plan through patience and discipline. Right? Don't fear growth. While consistency is important, don't be afraid to reevaluate your trading plan if things aren't working as you thought. As your experience grows, your needs may change. Your plans should always reflect your goals. If your goals or financial situations change, so should your plans. So yeah, always update your plans. Always have a risk management, you know, uh, roadmap with all your growth. You know, so don't fear growth. Choose the right broker for you. Oh, like wherever you're based in the U.S. in Europe, in Australia or Asia, make sure you pick the right broker for you and not one that basically charges the highest of commissions or doesn't give you the right leverage. It's critical to choose the right trading partner as you engage the forex market. Pricing, execution, and the quality of customer services can all make a difference in your trading experience. So yeah, guys, these are the sort of definition of forex trading, and how to trade safely. Always understand there's an there's fundamentals to follow in the forex markets. Like on Wednesday, we have the FOMC, for example, the federal fund rate in America. So this impacts most global markets because the dollar is a major pair. So you have things like this. You have technicals that you have to look into. Always look into technicals. Always be able to chart up and find your levels, and always update these levels. You know. So if you're looking at a day chart, uh, you know, look for the last 3 months and create your patterns, and then keep zooming into it. Go into the 4 hours. Go into the 1 hour. Go into the 15 minutes. Go into the 5 minutes. Go into the 1 minute. Always get your entry this way, but always learn how to do technical. So this is how these are things that will assess, and a mixture of these things will help you understand the market conditions, and then having a strategy will help you really adjust and move consistently in your goals as a forex trader, as a leverage trader. But I hope that helps. That's the education segment. Lightspeed. Thank you.